Out of the way, let's deal with the so-called bubbles head on. Now, the first of the obvious bubble they never seem to talk about, the haters, is not in the stock market at all. It's crypto, which has no real underpinnings when it comes to its actual worth. However, its relative worth versus the U.S. dollar is palpable. People view crypto as a hedge against potential inflation brought on by sky-high national debt, but when we actually had high inflation, crypto performed horribly. Doesn't matter. People still think it's a hedge against inevitable inflation from the government, and we've gotten to the point where there are exchange-traded products for Bitcoin, and there'll be some for Ethereum as well. And the hedgers are out in full force. It makes sense. Meanwhile, it feels like there are no Bitcoin sellers. That's what's bubblicious about it, even up here. So I can see crypto continuing to rally. Just remember to jump ship if inflation really does spike. Hey, by the way, the bump up in gold confirms the bull in and pull out of crypto. See, crypto is moving every speculative asset that's a hedge, because gold above 2,000 is speculative. Next, how about the non-bubble, though, in artificial intelligence? Let me start by saying that, sure, there are some stocks in the AI cohort that are overinflated, but that doesn't mean they can't go higher. See, I didn't really like that the super micro got added to the S&P 500s. That one's just blowing through levels at a pace. Makes you think it's stealing something really highly proprietary, and that's not the case. Super micro can and does have competitors. But let me tackle NVIDIA, up huge today. Now, it's the third largest company in the world with a valuation worth of $2 trillion. For a very long time, I've told you to own NVIDIA, don't trade it. I actually get called out in the street now a lot about it, which is really terrific. I like that. And I named my dog NVIDIA when the stock was about a tenth of where it is now. Why not trade it? Well, simple. The valuation's too low. And don't just look at today's price earnings multiple. That doesn't help you. I want you to think of it like this. Wall Street expects NVIDIA to earn $24 per share this year. I think that's a lowball number, but let's use it. Well, that number, the stock does look a little pricey, selling for roughly 35 times this year's earnings estimates. But now let's go back a year ago this week. At that point, NVIDIA, the stock, traded at $238. And there were many people who hated it and thought it was incredibly overvalued. But it was only overvalued because the earnings estimates turned out to be way too low. Do you know what it turns out to be? It's only selling for 10 times the current estimates for this year. That's right, when it was at 238, 10 times. We just didn't know they'd give us so many upside surprises. Now go to October. The stock stood a little more than $400 per share in retrospect. It was still selling for less than the average name in the S&P 500 when you look at 2024 estimates. Over and over again, it turns out NVIDIA's been selling at absurd levels. Crazy. Absolutely low. So if NVIDIA keeps trouncing the estimates, then I bet it ends up looking cheap once again. Now, isn't that the opposite of a bubble? Okay, now let's take Jensen Huang at his word, right? I mean, don't you think he deserves his word? He thinks the entire digital world is going to be turned upside down by generative AI, not just servers, not just the data centers, not just the PCs, not just the factories, not just the autos. I mean everything. This is what's really going on. We don't even know how big AI is going to be. We get bits and pieces from a Meta or an Amazon or a Microsoft or an Alphabet. We know that last week Dell talked at length about what can happen when you get all the NVIDIA high-end H100 chips you need. We'll know that Broadcom, they're going to address it on Thursday. AMD, a genuine rival to NVIDIA, will be talking to it at HP conference. These are all tremendous companies benefiting from the commitment to AI. It is undisputed that NVIDIA is the king of AI, and it's undisputed that this company has repeatedly surprised the upside. So let me ask you, how the heck are we supposed to value it other than against the estimates? And what do the bears keep? What do they have? What is their edge? The third alleged bubble? These GLP-1 weight loss drugs from Novo Nordisk and Eli Lilly. We have a worldwide epidemic of obesity. Just last week, the authoritative British medical journal Lancet raised its estimates for the number of obese people on the planet from 897 million to 1 billion. Diabetes is at epidemic proportions. Fortunately, we have reasons to believe these GLP-1 drugs lower hypertension and help with fatty liver disease on top of treating diabetes and making you lose weight. I think these are the most important new class of medicines since maybe antibiotics. How are we supposed to value them? It would be insane for Eli Lilly to have a cheap stock here, but the bears want us to make it cheap. We can't. Now, what's typically the case is that we do get a sell-off. I'm ready for it. We aren't all that overbought. The trusty oscillator says that. We aren't in bond trouble. We do have a labor report on Friday, and I'm still expecting a strong set of numbers, which is not what Wall Street wants to see. Strong job numbers could take a summer rate cut off the table and cause some serious concern that might lead to a sell-off. We see what's happening in Apple. That looks like it's rolling over. You know how I feel. Own it, don't trade it. I'm not fretting. I'm just expecting, and I have my shopping list of what to buy on weakness for the Travel Trust. You are never set for a big decline unless you are net short.
What do you think about all this? Is this the time to really dig in, keep piling into this momentum trade with mega cap tech, or look for some other opportunities? We're going to show a chart that you're pointing out that since October the 27th, if you look at the S&P and the S&P equal weight, they're trading pretty closely. I mean, the S&P is a little bit higher, but the equal weight's pretty close. So in your mind, where are we at? Are you what Jim Cramer might call a hater, or you're sticking with this mega cap tech trade?
I'm not a hater. I don't think the AI trades are going away, but I think this is a good time for folks to take some winnings and really think intelligently about where you want to be diversified. It's really hard to look at the Mag 7 and say this is the best trade now. And it's really kind of the Mag 3 because we've kind of lost a few folks from making all-time highs. Amazon just did, and it's going to continue to probably do that. But if we look at what I'll call the S&P 493 or the S&P everything else, that's had a pretty good year too. From that October 27th, you can see the, kind of where the S&P's been. And if you looked at just the Mag 7 version of that, they've been up 30%. That's pretty nice. But everything else has been up about 25 too. So you're getting a pretty good, trade, but picking up a lot of pretty good diversification at the same time.
Yeah, for the people just listening, S&P since October 27th up 24%, equal weight up 21%. Also, you're looking at something, it's not as sexy as the AI trade, but it's something that you think is a pretty good investment right now. Bonds, specifically corporate bonds. You gave us one way to invest, the ZTWO ETF. It's short-term corporate bonds. Why short-term corporate bonds?
Yeah, so we bought Z2 out, which was an opportunity for folks to invest in pretty precision targeted corporate bonds. We wanted to give folks current coupon. And I think where a lot of folks get side with the bonds is, one, there's an awful lot of them, so it's hard to pick things. And if you look at the bond indices, they're just chock full with thousands of bonds, some of which don't trade very well, so pricing is off. So we wanted folks to have the opportunity to be precise. We like the short end of the curve still, moving into some duration. There's a lot of new bonds in the 2- and 3-year market coming to offer on a regular basis. So investors are going to get that current coupon in the 4s and the 5s, as opposed to seeing yields of 4 or 5, but being forced to wait 2, 3, 4, 5 years before they ever see that total return in their portfolio.
All right, I know you also like retail. You call Target, which reports later today, you call it growth at a reasonable price, but I do have to say, analysts are expecting same-store sales to fall, a key metric for them. They also guided to sales to possibly be lower, maybe even flat. What's the growth that you're talking about when it comes to Target?
So longer term, Target's been on a nice growth tear. It's trading a little bit below its 17.2 trailing 5-year PE. It's about 16.8 now, so maybe a rounding error, but close enough. It is a pretty good beater of expectation, though. Last quarter, it had a pretty low bar, and it jumped well over it. Analysts have been warming recently. There have been little tweaks to their estimates, but 3 or 4 times it beats on top line and on bottom line. And, this could be another quarter for them.
All right, Target just reporting its earnings for the quarter came in at $2.98 a share on an adjusted earnings per share basis. That is much better than the street had been expecting, $2.42. Revenue also beating expectations, $31.9 billion versus the $31.83 billion the street had been looking for. Comp store sales down by 4.4%, but that was a little better than the street was looking for. Street estimate was down by 4.5%. And it looks like the fourth quarter gross margins were also pretty strong, 25.6%. The company is giving guidance for the full year, this full year that's coming on this, and says that for the full year, they're looking for comp store sales to be flat to up 2%. That's about in line with what the street was looking for. Adjusted earnings per share, they're looking for $8.60 to $9.60. $9.10 would be the midpoint on that. The street right now is at about $9.15. But it's going to take a difficult current quarter to get them to that point. They are looking for first quarter earnings per share of $1.70 to $2.10. The street was at the high end of that, $2.09. Comps, they're looking for down 3 to down 5%. And that's about in line with the street's expectations of down 3.6%. You see the stock is up pretty sharply, about 5.8%. Probably not just because the current quarter is better than expected, but because their operating margins and profit margins have gotten a lot better. They do say for 2023, that's one of the highlights that they point out. Operating income margin, 5.3%, was nearly 2 percentage points higher than it had been the year before. And their operating income dollars were up by about $2 billion compared with that. So again, right now that stock is up by about 5.8%. The CEO, Brian Cornell, is going to be speaking to the street today, really laying out what they expect to see. That's happening at 9 a.m. Eastern time. But before that, Brian Cornell will join us right here on the Squawk Box set in an exclusive interview. That's coming up in about half an hour's time, 7 a.m. Eastern.
Huge stealth rally been going on. And the chart doesn't look a whole lot different than a Home Depot or a Lowe's or a lot of retailers. I mean, this stock, I don't know if we'll be able to see it. You can a little bit. That in October, November there, that's 102. 102. So if I can quickly tell you it's up about 50% or more in that time period. So, some people thought Target had, inventory issues or woke-ish or whatever it was, but it still just moves like they all move in sync. And I think it was the chances of a recession diminishing for all the retailers, and suddenly there was a bid for all of them.
Attention all investors. Are certain hot stocks actually bubbles ready to burst or hidden gems poised for explosive growth? In today's video, we'll dive deep into the latest market trends, analyzing recent news and earnings reports to uncover the truth behind the hype. Thank you for joining InvestMinder. If you haven't already, be sure to subscribe to stay up to date on our latest investing insights and analysis. Disclaimer, please remember that InvestMinder is for entertainment and training purposes only. We are not financial advisors and this is not financial advice. Always do your own research before making any investment decisions. All right, buckle up. Let's dive into the market madness and see what we can uncover. Cryptocurrency, just the word itself sparks intense debate, and the question of whether it's a bubble on the verge of bursting is a constant source of speculation. Our expert wades into this heated discussion, acknowledging the initial allure of crypto as a potential shield against inflation. However, he tempers the enthusiasm by pointing to its erratic behavior during previous periods of high inflation, casting doubt on its effectiveness as a true hedge. But here's the twist. The landscape has undergone a transformation with the arrival of exchange-traded products, ETPs, like Bitcoin futures. These ETPs essentially allow established institutions to invest in crypto through familiar financial instruments. This influx of institutional involvement suggests a shift in perception, potentially indicating that crypto might not be just a fleeting trend. This newfound legitimacy could fuel further growth for cryptocurrencies, but our expert warns against getting swept away in the hype. He emphasizes that despite the potential, the crypto market remains a wild ride. Unlike the relative stability of traditional stocks and bonds, crypto prices can experience dramatic swings in value within a short period. One day you could be feeling like a financial genius, and the next, you might be left wondering what hit you. This inherent volatility, while potentially offering high rewards, also carries the risk of significant losses. Think of it like this. Imagine a bottle of soda. When you first open it, the fizzing creates an exciting spectacle, and the drink might taste refreshing. However, if you shake it up too much, the pressure builds, and eventually, the contents erupt in a messy explosion. Cryptocurrencies possess a similar kind of fizz, offering the potential for quick gains, but also carrying the risk of an unpredictable and potentially disruptive outburst. Therefore, while the future of crypto holds intriguing possibilities, it's crucial to approach it with clear eyes and a healthy dose of caution. Remember, crypto is not a guaranteed path to riches, and its volatile nature can turn a dream into a nightmare if not handled responsibly. So, before you jump into the crypto frenzy, take a deep breath, do your research, and understand the inherent risks involved in this exciting but unpredictable market. The conversation now shifts towards two exciting advancements with the potential to revolutionize their respective fields: artificial intelligence, AI, and weight loss drugs. While some AI stocks might appear overvalued based on current metrics, our expert highlights a clear frontrunner, NVIDIA. Despite its impressive price tag, the company's consistent track record speaks volumes. Time and again, NVIDIA has exceeded earnings expectations, solidifying its position as a dominant force in the AI space. However, the analyst urges viewers to look beyond the hype. He emphasizes the importance of focusing on a company's fundamentals, even if its valuation initially seems high. NVIDIA's consistent performance justifies its premium, making it a strong long-term investment for those seeking exposure to the booming AI industry. The emergence of GLP-1 drugs marks a significant development in the fight against obesity and its associated health risks. These drugs offer promising results in treating diabetes, lowering blood pressure, and most importantly, aiding weight loss. The analyst compares the potential impact of GLP-1 drugs to the introduction of antibiotics, highlighting their revolutionary potential. He emphasizes the profound impact these drugs could have on the healthcare industry, potentially saving countless lives and improving overall well-being. However, a crucial reminder is issued. Don't get swept away by the excitement and blindly chase any investment opportunity. Thorough research and a disciplined approach are essential. Remember, even promising advancements like GLP-1 drugs require careful consideration before making investment decisions. The recent surge in mega-cap tech stocks has left many investors wondering, is it time to double down on these tech giants, or should they consider diversifying their portfolios? Our expert dives into this question, offering valuable insights for those navigating this dynamic market. While acknowledging the impressive performance of mega-cap tech stocks, the analyst expresses a cautious optimism. He suggests that while they might still be a good option, it might be wise to consider diversifying your holdings to mitigate risk. The analyst proposes the S&P 500 Equal Weight Index as a potential alternative. This index offers similar returns to the traditional S&P 500, but with a twist. It assigns equal weight to each of the 500 companies, instead of weighting them based on their market capitalization. This approach provides exposure to a wider range of companies, potentially offering more balanced diversification and potentially mitigating the risk associated with relying solely on a few dominant players. Another potential avenue for diversification discussed is short-term corporate bonds. The analyst highlights the Z2 ETF as an example, offering investors exposure to a basket of short-term corporate bonds. These bonds typically offer higher interest rates compared to longer-term bonds, making them potentially attractive in an environment of rising interest rates. Additionally, their shorter maturity allows investors to access their invested capital sooner, offering greater flexibility. The analyst then shifts the focus to a specific stock, Target. He describes it as a growth at a reasonable price option, highlighting its consistent track record of exceeding earnings expectations. Despite facing concerns about potential headwinds, Target demonstrates strong fundamentals and a commitment to growth. This combination positions it as a potentially appealing investment for those seeking a balance between price and growth potential. Eyes were glued to Target's earnings report, and the wait proved worthwhile. The company exceeded expectations on both earnings and revenue, delivering a strong performance that sent its stock price surging. While same-store sales dipped slightly, the decline was less severe than anticipated, offering a sigh of relief for investors. Additionally, Target's gross margins impressed, demonstrating the company's efficiency and cost management capabilities. But the excitement didn't stop there. Target unveiled its full-year guidance, and the outlook appears promising. The company anticipates flat to slightly uptick in same-store sales, falling in line with analyst expectations. This projected stability instills confidence in Target's ability to navigate the current economic climate. However, the analyst reminds viewers that the road ahead won't be entirely smooth sailing. The first quarter's earnings per share guidance came in lower than expected, indicating potential challenges in the near future. Despite this, Target's overall performance and optimistic outlook paint a positive picture for the long term. The analyst delves deeper, highlighting the remarkable stealth rally Target stock has experienced over the past few months. Its performance mirrors that of other major retailers like Home Depot and Lowe's, suggesting a broader shift in market sentiment. This trend could be attributed to receding fears of a recession, leading to renewed interest in the retail sector as a whole. Remember, the information we discussed is just a starting point. Before making any investment decisions, do your own research, consider your risk tolerance, and consult with a financial advisor. Invest like a pro, not a gambler, by focusing on fundamentals, building a diversified portfolio, and staying informed. Here at InvestMinder, we're committed to helping you navigate the financial landscape with confidence. Be sure to subscribe for more insightful videos, market analysis, and investment tips. And remember, happy investing.
Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.